And my name is Brett Holland from STIFEL. My business partner Mike Battistelli with STIFEL as well. And then many of you know Kevin Caron with Washington Crossing. He manages a portion of the overall pension, has been here before. Primarily equities is the piece that he manages, and so he'll be speaking a little bit more to that here in a few minutes. So to get started, if that's all right. So just to get started, we'll start off with the report that we normally start off with you all, the quarterly report. I'd ask you to look at the bottom right, page 4 of 11, just so we're kind of on the same page there. And this is, again, for the quarter, so this is ending June 30th, and as we always do, each time we come in, Mike will have updated numbers, which actually are a little bit more favorable than what the first quarter or second quarter has been. But kind of looking through at the top left-hand side, we have current period, and then there's quarter to date. And I'll just kind of read down through those numbers. So quarter to date, at the beginning of the quarter, the balance was $142,727,536. And then cash flows of in and out, more or less withdrawals on the pension fund was $505,000 there. And then the overall return of the loss for the quarter was $15 million. And then the ending balance was $126,670,323. And then you can see the year-to-date number to the right of that. We started at the beginning of the year at $153 million, had withdrawals of $3 million, and a loss of $23 million, and then we're at $126 million at that point in time. And then the since inception number is kind of over to the right.
May I just interrupt? That is a big number, 11% or whatever, but I had in my head 17, based on some other things that I've seen for the end of June 30. So that's really pretty remarkable to me.
Thank you. Kevin will talk a little bit more. It's been a challenging, as I think most people know, a pretty challenging market. Moving around to the bottom right-hand corner, just to kind of talk about allocation again a little bit. In the bottom right-hand corner, we have cash equivalents listed. It's a little bit of a rounding thing, listed as 0%, but a very small percentage that's actually in cash right now, or what we would call like FDIC insured money market. To the right, equities or your stock portion is 63%. Your fixed income is 30%. And then alternative, what we call alternative investments, is actually the REIT portfolio, the Real Estate Investment Trust, is about 7%. And any questions on any of that at all? I just wanted to comment real quick. I don't want to take too much time because Kevin always has great insight, but I want to just comment real quick on the 30% fixed income. So bonds are traditionally considered to be more conservative than what stocks are. Most people know that. And one of the big reasons, there's multiple reasons, but one of the big reasons that bonds are considered to be more conservative than stocks is bonds, we always say they have a memory. So they always revert back to what's called par, where they start. So every bond, whether it's a municipal bond or a U.S. Treasury bond or a corporate bond, no matter what it is, it always starts its life at $1,000 at what they call par value. And during the life of that bond, like a CD would, they pay interest over the life of that bond, and that interest payment stays the same. And during the life of that bond value might go from $1,000 and it might work its way up to $1,100 and it might work its way down to $850. But at the end of the life of that bond, when that bond matures, it always reverts back to $1,000. So you know where it's going to end up at. Where stocks, if somebody buys a stock at $80 and it goes to $60, well, the stock doesn't have a memory. It doesn't remember that it was at $80. It could go to 40 or 80 or 60 or whatever. But the fixed income portion in here right now, with what's going on with interest rates, and Kevin will probably talk a little bit about that, your fixed income or your bond portion has been pushed down some. But we're not selling those bonds. We're going to hold those bonds, and those bonds, as they mature, they revert back to $1,000. Make sense a little bit? Any questions on that at all? All right. So I'll ask you to turn to page 6 of 11. Go there. And kind of going across the bottom there. So we have you see the totals on the bottom left-hand side. We'll kind of move over to the quarter-to-date return. So for the quarter, again, from April, May, and June, the pension was down 10.86%. Year-to-date, it's 15.62% as a negative. One-year number, which is a 12-month number, of 9.94%. And then you see a 3-year number there, a positive of 4.25%, and then a 5-year number of 5.73%. And then the 10-year number, which I know you guys focus a lot on, is 6.83% is the 10-year average. So with that, I'll let Mike join in there.
Yeah. So just going to give you an update where we stand through yesterday. I think it's always good to know kind of information at the end of the second quarter, but through yesterday.
Excuse me, Mike, I don't want to, but you just reminded me, is there an attorney here with you
Your
today?
other colleague back there.
We brought our.
I can tell that's the brains.
We brought our boss with us today. That's my youngest daughter, Kaylee. She's just
Welcome.
come over to work with Dad today a little bit. So.
Awesome. Welcome. Sorry.
That's okay.
Sorry.
So the balance, again, this is the unaudited number. We won't get that till the end of the quarter, but through yesterday, the pension plan stands at $136,479,993. The performance is down 8.32%, again, through yesterday. That last page that Brett just shared with us, the 12-year or the 1-year number was down 9.94. And our 12-month number now is down 5.25. So things are trending the right way. Kevin will probably speak to that, but since the middle of June, the stock market has firmed up and has actually been doing fairly well, a little less volatility. There's a number of reasons for that, and I'm sure Kevin will touch on that. As far as the allocation, at the end of the quarter, we didn't have very much in cash. And that's because we were waiting for the ARC payment, the annual payment to come in. So we do have about just under 6% in cash now. And that's for future months' payroll and so on. So we do stand there. Equities stand at about 60%. The REIT portfolio is still around 7%. And fixed income is around 27%. So pretty similar, except we do now have some cash, which we were planning on. We kind of worked with you guys to know the timing of when that cash was going to come in. Any questions on that update? Or
could you repeat the number that you gave? Was it 13 million?
135.
136 million?
136.
Yeah, 479,000.
993.
993, yeah.
Okay, thank you. I didn't get my commas down, and I'm like, I wanted to make sure I had it right.
Sure.
It's about 10 higher than the quarter.
Then the quarter end, right.
Anyway, but that's, I knew it came back strong, but it was that quarter was brutal.
Yeah, it was, the second quarter was very, very challenging, particularly June. It was mostly the month of June, to be honest with you. But, yeah.
Kevin, make us happy.
Turn it over to Kevin.
Predict the future.
Thank you. Well, Michael's right. It's been a historically difficult first half of the year, especially for the bond market. If you went back and looked at, as Brett pointed out, bonds typically your safe go-to asset for preservation of capital. This was not the year for that, but the kind of year that we had in the first part of the year, with interest rates rising as the Fed raised interest rates to combat inflation, that puts the poor performance of the bond market on par with historic bad markets. And to put it in perspective, 1994, Alan Greenspan stepped in, doubled interest rates very quickly. The bond market had its worst year since 1926 in 1994. This year is on par with that in the first 4 months of the year. The 5-year Treasury, which usually doesn't do anything, it's like watching paint dry, fell by 7%, which was huge in bond market terms. So on par with the losses we saw in 1994 when we had a similar bond market rout. And to find another time that was like this year, you would have to go all the way back to the late 1970s and Jimmy Carter and Paul Volcker, who had to raise interest rates to nearly 20% in order to combat this inflation of the 70s. So after a long period of very, very low interest rates and no inflation anywhere to be seen on the horizon, suddenly inflation has arisen as culprit number one, and has really upended the shopping cart about how policy is going to play out. So the whole market is the whole bond market was jostled around by that for the beginning part of this year. We don't expect that kind of volatility to continue, and the upside of all of this is that we do have higher interest rates. So as coupon payments come in, as other cash flows come in, we actually have the opportunity to invest money now at higher interest rates, which if you go back 10 or 15% in past conversations, the problem was always, well, there's no interest rate. So we were lamenting low interest rates. Now we have higher interest rates. And so the silver lining in the bond market is that this reset gives us a chance to earn some money going forward. So that's a positive. Now, this reset in the bond market has affected other things. I like to think about the bond market and interest rates as effectively, especially the U.S. Treasury market, as effectively the nervous system of the entire financial apparatus of the planet. So all other assets, from real estate to stocks to you name it, are dependent upon interest rates, and when interest rates rise, the value of other assets, future cash flows, goes down. And very predictably, that's what we saw in the stock market. So while the bond market came under pressure, we also had similar pressure in the stock market. I want to step back about 18 months, 24 months. We came into 2000 with an unprecedented pandemic, met by unprecedented amounts of money creation, stimulus, spending to keep the economy moving forward in the wake of the pandemic. That was like a giant rock being thrown in the pond, and the ripples of that are still being felt today. So initially, the pandemic struck, we lost 40 million jobs in the country. It looked like a complete disaster economically, but what ended up happening was the money that was created and put into the economy buoyed the stock market, put money in lots of people's pockets, and forcibly kept the economy moving forward. We are now on the other side of that. So the first year or two was like a party. The stock market had a great run, but now we're on the other side of that, where we're not going to be seeing that again anytime soon. So we're starting to see tightening of financial conditions. It is essentially the hangover after the party. And as this happens, we are confronted with a legacy of that spending, in our view, which is this elevated rate of inflation, which is still with us. And it's going to take some time to work out. So we're not in the camp that this is going to immediately be over. There is some more work that's going to have to be done. The Fed is expected to raise interest rates maybe another 50 or 75 basis points in September, and again thereafter. We're getting to a point now where the market has started to think about the effect of these higher interest rates, cooling inflation, and that thought has helped to give the lift to the market that you've seen over the last month or two. But we can't rest on our laurels. We can't say, well, okay, this is it. The bottom was put in June, so therefore it's party time all over again, and we could just go take reckless risks. That's not what we're saying. What we're saying at Washington Crossing is that we are in a new world where inflation is forcing the hand of monetary authorities around the world to do something that they haven't had to do in 40 years, and we still need to be very circumspect about how we move forward, even though the higher interest rate eventually is going to help the portfolio and returns. So what are we doing? As we always have, quality is job number one. I think there's a commercial, I can't remember where I've heard that, maybe it's Meineke Muffler, I'm not sure. But the idea about quality relates to, it means something specific to us, it's not just a marketing term. What quality means to us is that the businesses we own need to be dependable and durable and predictable. And how do we get there? We own companies that have very little debt. We own companies that have highly profitable assets. We own companies whose profits are very consistent. We think if we do all three of those things and then buy those companies at a price that pays us well to take on the risk, we should be in relatively good shape. When you look at the performance of the equities that Washington Crossing has been running on behalf of the county, I think we're down about 3 or 4% for the year, something in that neighborhood. We have had cash in the portfolio. We've recently just begun to deploy a little bit of that cash, but we're going to be very prudent in terms of how we do that. And we're going to make measured investments when we get to a situation where we see something that's paying us well to take on the risk. If we don't see quality companies that are paying us well to take on the risk, we're going to remain very conservative and hold the cash in the portfolio that we have there presently. So we're in a challenging spot. The macro environment has changed in ways that we haven't seen in many years. There are lots of different cross currents. One of my favorite, the quote of the week last week was an economist who said, we're either in a recession or things are booming. And I think that's exactly apt. That's the right answer, because there are cross currents happening here, like a pond that has had a large rock dropped in it, that's creating a lot of stir and confusion. But I'm confident that we're going to get through it. We're going to stick with our knitting, looking for these quality kind of companies. And as we've delivered good protection on the downside in the past, we anticipate doing that in the future. And we appreciate and thank you for working with Washington Crossing and the trust you placed in us.
Did you mention inflation when you see that toward the end of the year? Would you have a prediction
On inflation? Okay, so inflation is usually measured by the consumer price index, although that's a reflection of the economic reality. The economic reality, we tend to think, has a lot more to do with what happens to the value of money, broadly speaking. But if we use the inflation rate, this consumer price index, as a proxy, what the bond market is looking for is sort of a flattening out of the inflation rate. So we have securities called Treasury inflation protected securities, which tell us at least what the bond market thinks in real time about inflation. And those numbers have flattened out. They were rising sharply through the fall. Now they're flattening out. And what the market, the stock market, I guess the bond market too, is looking for, and the Fed, is to see those kind of market implied inflation rates keying off the consumer price index start to come down. We haven't really seen that yet in a convincing way, but at least we've seen some flattening out. But for us, it's just going to be about playing defense. You don't want to own, for example, companies that have a lot of debt, because if you have companies that have to roll over debt, as the county benefits, as cash flow comes in and you reinvest it because now you're earning higher interest rate. If you're on the other side of that, let's say you're a business and you have a lot of debt, you're going to have to roll over debt as it comes due and take on higher interest costs. So one pillar of our quality proposition, especially in an inflation environment with rising interest rates, is to focus on companies that have very low debt so that they can do better in an environment where they may have to roll that debt over in the future. But to answer your question directly, we have not seen a convincing coming down of that inflation rate yet.
So, as I recall, Washington Crossing is, you're probably our most conservative manager and always have more cash than anyone else on hand. Is that, am I recalling that correctly?
Well, we have the latitude in our mandate to hold cash in the portfolio. And effectively what we've done, we look at stocks like bonds. So as the prices come down, all else being equal, the expected returns go up, and we hold a floor, we hold a threshold. So if we can't find something that's going to pay us, let's say 3 or 4% these days, at least, then our mandate says hold cash, wait for a better opportunity. So last week, for example, I think it was last week, we got an opportunity to buy Google. Google used to be high, and now it came down, and consequently it allowed us to release some cash at the right price for a better expected return than it was in the past.
Okay, you're anticipating my question probably.
Yeah.
Is
Yeah.
are you looking for bottom, are you looking for bargains right
Yes.
now? And so obviously you
Yes,
are.
so every day we have a universe of 150 quality companies. We would call them like A or B quality companies as opposed to C or D grade companies. And we're trolling this universe all the time, looking for companies that, in our estimation, pay us to take on that risk. And when the prices come down to a level like was the case with Google, where based on our current estimation of the future value of Google, all of a sudden we have a better return, that allows us to put things out. And it causes us to be a little bit contrarian in our calls. In other words, we're going to be putting more money to work when prices are down. Conversely, when prices are up, the expected returns fall and we'll be taking money away. That's how we've always done it. And that's why I think you've tended to see more cash in the portfolio, because A, we're allowed to do it by mandate, and B, we have a mechanism by which we evaluate the expected return and only put money to work when we're well paid to take on that risk.
It wasn't a criticism, I was just curious to see if you were acting on any buys.
Yeah,
Like the
no,
good news
I
side, so-
didn't take it as a criticism.
Okay.
I just wanted to make sure I was being
Yeah.
clear about
No, you
the
answered.
mechanism by which we make those decisions.
During the financial crisis, the Victory portfolio had a pretty large, 14 years ago, you guys had a pretty large sum of cash position because there were no opportunities as well, right?
Yeah, so,
That's
yes.
probably my recollection.
Right,
Yeah.
exactly, that's what I kind of figured.
They
Commissioner Litz.
probably are a little more defensive because of that cash. I mean, all the managers, we've kind of built defensively, protective as best we can. But Washington Crossing probably goes a little over and beyond. I did want to add, they manage about $19 million of your portfolio, which is 14% of the overall portfolio. And Kevin quietly mentioned his performance. I had it through yesterday down to 2.8%.
Wow.
Compared to the S&P through yesterday was down 8.8. So definitely protecting on the downside through their principles.
Actually, it was just a comment.
Comment.
Yeah, that's all right. I just wanted to say, using your water analogy, I'm glad you're not predicting a tsunami.
Thank you.
Anything else?
That's it.
Okay. Well, thank you very much.
Yep.
Appreciate the report.
Thank you, Commissioners.
For good news.